Hello everyone. Today, we're diving into a fundamental financial instrument that's often mentioned but not always fully understood: bonds. Bonds are an integral part of the financial world, and understanding how they work is crucial for anyone interested in money and investing. First off, let's break down what a bond actually is. In simple terms, a bond is a loan, but instead of you borrowing money from a bank, you're the one lending money. When you buy a bond, you're lending money to an entity. This could be a government, a municipality, or a corporation. In return, they agree to pay you back the full amount of the loan on a specific date, known as the maturity date. Now, let's talk about an important aspect of bonds: the face value, also known as the par value. This is the amount the bond issuer promises to repay at the bond's maturity date. It represents the principal loan amount. For instance, if a bond has a face value of $1,000, the issuer is agreeing to pay you $1,000 when the bond matures, which is apart from the regular interest payments you receive. Let's take a look at an example. Suppose you purchase a bond with a face value of $1,000 and a 5% annual coupon rate. Over the life of the bond, you'll receive yearly interest payments based on the 5% rate, amounting to $50 each year. And when the bond reaches its maturity date, you'll receive the $1,000 face value back. However, it's key to remember that a bond's face value is different from its market price. The face value remains constant and is what you'll get back at maturity, but the market price can change due to factors like interest rate fluctuations and the credit rating of the issuer. This means that you might buy or sell a bond at a price above or below its face value in the market. Understanding this distinction is crucial, especially when evaluating a bond's potential return and risk, particularly if you're considering selling it before it reaches maturity. Now, let's talk about different types of bonds. Government bonds are issued by national governments and are often considered low-risk investments. Then there are municipal bonds, issued by states, cities, or other local government entities, often to fund public projects. Corporate bonds are issued by companies. Generally, the riskier the borrower, the higher the interest rate you can expect. It's also important to understand bond prices and yields. Bond prices can fluctuate in the market, much like stocks. If a bond's price is above its face value, it's said to be trading at a premium. If it's below, it's trading at a discount. The yield is the actual return you can expect on your bond, taking into account the price you paid for it and its coupon rate. Now let's take a look at interest rates and how they affect bond prices. A critical aspect of bonds is their inverse relationship with interest rates. When market interest rates rise, bond prices typically fall, and when interest rates fall, bond prices rise. This is because the fixed interest payments of a bond become more or less attractive compared to the new bonds being issued. Understanding this relationship is key, especially if you're considering selling your bond before it matures. You could end up selling it for more or less than you paid, depending on the interest rate environment. Bonds also come with varying maturities. Short-term bonds may mature in a year or less, while long-term bonds can last for decades. The maturity date is important because it affects the bond's sensitivity to interest rate changes and the overall risk profile. So, bonds are a crucial part of the financial landscape. Remember, the key to successful investing is knowledge and diversification, and bonds can be an excellent addition to a well-rounded portfolio, offering both balance and stability.